So let me pick up from where I left off the other day and just sort of talk about buying on margin and short selling. So as I said, margin buying is no different from an activity we all do. It's really nothing. It's when you buy something by borrowing money. So when you borrow money and buy something, whether it's a property, whether it's a car, whether it's stocks, really the underlying idea is the same. Okay, so you're borrowing. In this case, you can borrow stocks. Borrow money to purchase stocks, and you usually borrow money through your broker. And so there's a separate approval process, as I was saying, just like getting approved for credit through a bank. If you want to go for a bank loan, you have to fill out paperwork. They will do a credit check on you to see what kind of how you've been as a borrower, etc. The process of getting approved for margin purchase works pretty much the same way. You fill out the paperwork with your broker. They do a credit check, and if you get approved, then you can borrow money from the broker. And by law, you can only finance up to 50% of your investment purchase. Up to 50%. The other 50% has to be yours. So short selling, on the other hand, is where you sell something you don't own. So when you short sell, you are selling something you don't own. So when you sell shares, shares that you do not own, that's short selling. So that kind of sounds counterintuitive. How are you going to sell something that you don't own? Well, the way it works is that you borrow shares from your broker. So rather than borrowing money, as in the case of buying on margin, you actually borrow shares. When you borrow shares from your broker, then and sell them, that's short selling. So you didn't own the shares to begin with, but you borrowed them from your broker, and then you sold them, and that operation is called short selling. And so the big question is, why would you want to do that to begin with? Well, what's the purpose? And the purpose is, let's say you do your research, and for some reason you know, legally or illegally, you've come to find out that stock X is going to go down in value in the next few days, week, or whatever. In short order, it's going to go down in value. Now this is information that you have, or belief that you have, and you want to profit from it. How can you profit from that information? It's negative information, so there's no buying involved. So what you can do is you can sell it, but let's say you don't own shares of that company. So there's really nothing to sell directly, so you borrow. So again, there's a whole approval process. To get approved for short selling, you have to do more paperwork and get approved. And once you get approved, the broker will place X number of shares, as many as you want, in your account. It'll be there, and then you are free to sell it, and the proceeds stay in the account. And then, of course, you have to return the shares back to the broker at some point, just like money. When you borrow money, you have to repay the money. You have to repay the principal with interest. When you borrow shares, the process works the same way. You have to pay your fees, borrowing fees, and you have to replace the shares. So the idea is that if you're right in your estimation of that stock, then you sell high. Obviously, you sell that stock at its current price, and then buy it back in a week or so when the price has gone down. So if you are right in your information, belief, whatever, then you'll be able to sell high and then buy it back later, whenever that is, at a lower price. So you sell at a higher price, buy it back at a lower price. The difference minus commissions and all that you have to pay is your profit, right? So make sure you understand that process. So short selling, again, is borrowing shares you don't own for the explicit purpose of selling at current prices. But then it's a borrowed shares. It's not your shares. You have to replace shares and pay commission and interest and all that on the shares you've borrowed. But the idea is that if you sell high, buy it back later at a lower price, the difference is the profit you make. So that's one way to make money in a negative information context. When markets are going down, you make money by short selling. That's what people do. Okay? it's a risky operation, right? It's risky because both buying on margin and short selling are risky operations because they involve what is called leverage. When you borrow money or borrow shares, you're leveraging yourself. Leveraging has the when you're right with leveraging, you make more money than you would normally, but you also lose more money than you would normally when things don't go your way. So that's why it's considered risky. Leveraging is considered risky for that reason, that your losses and wins are both magnified because of the leveraging effect. So, okay. So in order to figure out these trends, stock price trends, because let's say you are trying to trade based on, you want to catch a momentum action. You want to short sell, let's say, on a downward momentum. When the downward momentum starts in a stock, you want to catch it early enough where you want to short sell and then buy back later when it's gone down in value at a certain point. You want to buy it back, pay back your borrowed shares, and capture the rest in profits. So how do you capture? So the big question is how do you figure out when a trend has started, either an upward trend or a downward trend in stock prices? It turns out that there is this very well-known statistical measure called moving averages that you can use to compute trends. And the most popular trends are these 50-day moving averages and 200-day moving averages. And 50-day, so what is a moving average? Moving average is nothing but, when you say a 50-day moving average, what you're doing is you're taking the previous, so on a given day, you're looking at the window 50 days before, okay, 50 prior days. You're taking the average price, let's say average price, daily price, 50 average prices, and you're calculating this average of those average price, and you get the moving average price, 50-day moving average price today. Then tomorrow, you're going to drop out the 50th day, replace it with the most recent day, and have another moving 50-day window. And so what you're doing is you're having a trailing and moving 50-day window relative to the current day. And you're calculating the average price of that window every day. Okay, so when it's a 50-day moving average, you're doing that with a window of 50 days, 50 prior days. When it's a 200-day moving average, you're doing it with a window of the prior 200 days. So not surprisingly, the 50-day moving average captures short-term fluctuations in price, where the 200-day moving average captures a relatively longer-term fluctuation in price. So 50-day moving average sort of proxies for short-term price movements, whereas 200-day does so for the longer-term movements, price movements. So you want to calculate, so that's two ways to calculate trends, short-term trend and long-term trend. 50-day moving average captures the short-term trend, 200-day moving average captures the longer-term trend. And there are various rules. None of these are scientific. They're just basically what people believe in. They've observed it, and people report it as, So 50-day, 200-day moving averages are very popular ways to gauge short-term and long-term trends. There are other ways you can do it. You can have 100-day, 250 days. Different people try different things, but the 50 and 200 are considered to be the most popular to capture short-term and long-term trends. And so here's one arbitrary rule. You can have a buy rule if the stock price breaks through both the 50 and 200-day moving averages on the upside. So you have the 50-day curve, and do we have an example of that? Yeah, we do, right? So let's pull that up, and we'll demonstrate that. We'll demonstrate that with Microsoft. Again, this is something you can do yourself. There's nothing magical about what it is being done here. All these, Yahoo will do it for you. You just have to click a few clicks, and you can do this. So you can see that the red is which one's the current? Okay, so you have the current share price, which is the zigzag line, I'm assuming, right? Yes. And then you have the red one, I haven't seen the labels, it's a 50-day moving average. I can tell you, and I'll tell you why. And the green one is the 200-day moving average. I don't even have to see the writing labels, and I can tell you. And the reason is the 200-day moving average is smoother graph. It's always going to be relatively smoother than the 50-day one, which is going to be relatively curvy. Because it's capturing short-term trends, so it's going to have more peaks and valleys than the 200-day moving average, which is going to be a relatively smoother line. So that's how you can tell. So now you have the share price superimposed by the 50-day and 200-day moving average. And so when the stock price cuts both the 50 or moving, so the idea is, when does an upward trend start, right? So you want to sort of use the 50 and moving 200-day graph so this one here is a good example of where this particular rule right here. Okay, so right here. The stock is cutting through both the 50 and the 200-day moving average right here. So this would be a start of an upward trend. Okay, so now you may say, but this is in hindsight. This is ex post, as I say. That's true. That is absolutely true. That's one of the weaknesses of these kind of technical analysis. This is all called technical analysis, just looking at data patterns, trying to figure out patterns in data without really any basis in theory. But there are enough observations that say that, okay, when this happens, when the stock price cuts through both the 50 and 200 days on the upside, moving up, then more often than not, an upward trend starts. That is not to say that it's going to happen every time. That's the problem, is that if you think that this is a foolproof idea, that every time this happens you're going to make money, not so, right? So you can be disappointed, but more often than not, this will happen. This might happen, that when the stock price cuts through those 2 points, the 50 and 200-day and moving up, then an upward trend has started. So this would be a good time to buy. Somewhere in this range would be a good time to buy. And as you can see, you can ride it up. You know, obviously at that point in time you wouldn't know exactly where to get out, but you can pretty much sort of walk through that and decide when you want to get out. But so that's sort of and then you can see here is where the downward trend has begun, right here. You can see the start, and so you can have a rule. For example, based on this, you can study the patterns for a while on a given stock, and then say, okay, so if the stock price were to cut through the 50 and 200 on the upside while it's moving up in an upward direction, then that's a buy signal. And when the reverse happens, that it cuts through the 50 and 200 on the downside, I'm going to use it as a sell signal. Okay, I'm going to get out at that point. And that might work for you. Not always, but likely that it might in a lot of cases. Yes?
So you're saying where the 200-day goes beneath the 50-day?
No, I'm saying when the stock price itself, so this zigzag line, this is the actual graph of the share price, Microsoft, right? And then you have the green and the red lines. Those are the 50 and 200-day moving averages. So I'm saying when the share price cuts through both those green and red lines in a downward direction, that's when it's a sell signal. You can use that as a predefined rule, that I'm going to use that as my sell rule. Make sense? Yeah. And the reverse is the case here. So I mean, and like I said, there are people who swear by it. I mean, if you go online and check, there's a whole community of people who live and die by these kind of signals, trying to figure out each stock, because each stock has a very distinct pattern of behavior. So when people do these kind of things for a living, and there are a lot of people, thousands of people who do technical trading and make a living out of it. They've given up their careers, they have high-speed connections in their bedrooms or whatever, and they study at home in the basement, and they're just playing the market this way all day and making money and making enough money to live. So this is a way of life for a lot of people. And I just want to introduce you to it. I have my reservations about it. It's a hit or miss as far as I'm concerned, but it's one way to look at it, and there are people who actually swear by it. And there's a ton of software that you can license and all that, all claim to give you the extra edge for you to make money and all that stuff. So anyway, so I wanted to share that with you. I'm going to figure out and not let it shut down like that. Okay, so then the big question is, are moving averages an effective way to gauge talent, gauge trends, or to figure out trends? And the answer is yes. The short answer is yes. If you look around in the internet, you'll see that there's a lot of negative stuff that's said about moving averages as a way, but really, if you look at it with today's high-frequency data, you will see that it really does a pretty good job of picking out trends. So if you have, let's say, for example, in the stock challenge that we will be participating in when does it start? In a week or so? Okay. You will see that there'll be a way for you to look at momentum and see if you trade on momentum strategies. So the idea is to figure out when a trend might be beginning and take a position, or even when a downward trend might start, to take a position by short selling securities and make money. So you can try it out and see if this sort of works for you in this simulated setting. But moving averages are a pretty effective way to gauge, to figure out trends in stock prices. So, okay. All right. So, and here's another one I'll just mention in passing, moving on. Another one of these technical analysis tools is, apart from the 50 and 200-day moving averages, is Bollinger Bands. And again, Bollinger Bands are these bars around the midline, and you can see the up and the down. These basically take volatility of the stock into consideration. So John Bollinger was one of these traders who came up with this way of looking at stocks, and so this Bollinger Bands is named after him. So it's basically doing the same thing with Microsoft. We're just sort of putting a frame of upper bounds and lower bounds on Microsoft stock price, and the idea is that when the bands widen, it's when you have more volatility in the stock, and when the wide bands narrow, that's when there's less volatility in the stock. So a lot of times people use these as a way to look at, if there's any edge in trading, when do you want to get in. The whole idea is making money in trading, right? So you want to hopefully buy low, sell high, and capture a little bit of money, and you do it oftentimes. You make a sizable amount of money. So if you clear a little every time and you do this process 200, 300, 400 times during the day, then pretty soon it adds up to some sizable or significant money. So I'm going to just move on here. Okay, so if you have any questions, let's see. Are the moving averages directly reflective of the situation of the company? Absolutely no. Moving averages are, well, actually, let me take that back. Upward trends and downward trends can start because of corporate-specific stuff. So yes, in a way, because when you have something good going on, yes, there might be a lot of people who get wind of it, try to buy it. So it's all supply-demand, right? Ultimately, prices are being driven by supply-demand pressures at any time the markets are open. So suddenly, if there is a positive spike in demand, for a stock, then its price is going to go up, and that could well be driven by company-specific news, or about to, word gets out, there's some leakage as to a new CEO who's been appointed, or maybe a CEO who is not well or about to resign. That's negative stuff. So yes, a lot of times these things leak out in the market before formal announcement, and those affect stock prices one way or another. So yes, my initial answer was wrong. Yes, it is driven by company stuff, but not always. Not always. But yes, it can well be driven by company-specific stuff. All right. So, okay. So behavioral finance is fast gaining a lot of traction in the field. As I told you in one of the earlier lectures, that we never really believed in behavioral finance until the last 15 or 20 years. And didn't believe that there was any role for individual decision-making biases and all that stuff. That it was all mean variance, and that emotions had nothing to do with stuff. And so now with increasing traction, people coming to believe that indeed there's a lot of behavioral biases. We as individual investors display a lot of problems with our and we don't always behave rationally in the most rational way possible. So behavioral finance has become quite an important way to look at a lot of finance decision making. And one of the ways of looking at within this framework of behavioral finance, this idea of framing becomes very important. So as I told you earlier, with the traditional finance model, if you make money, you're a winner. If you lose money, you're a loser. There's just no ambiguity about winning and losing. You make positive gains, you make positive returns, you're a winner. If you don't, you're a loser. So it's very easy. It's accounting based, no room for error. You can see it, you can judge it. Well, behavioral finance says not so fast. You can lose money and yet be a winner. How? Well, it's how you frame the matter. It's how you frame the question. So if you, for example, you lose a lot of money in an investment, in some harebrained scheme that your brother-in-law talks you into and you lose a ton of money, normal, conventional finance would say, you're a loser. But you lost money, i.e. you've lost, and there's no way around it. But behavioral finance will say, wait a second, that's not totally correct. Let's say I use you in this example, let's say you lose a lot of money, but you say, you know what, I've learned my lesson. This is a way for me to learn. It is a wake-up call. I'm never going to do this again. And so if you frame the issue that way, then you're a winner. Right? You look at that as price of admission, or tuition, if you will, or in the School of Hard Knocks, right? So you learn that, and so that's how you can frame the issue. So depending on how you frame it, you can lose money and yet not lose. Okay, so that behavioral finance gives you that latitude of interpretation, which conventional finance has never allowed. Okay, so and of course the rational expectation, which is the conventional model, says that individuals behave rationally, have consistent opinions and beliefs, use all available information, and are unbiased by emotion and herd effects. All of these have been proven false in recent experiments and stuff with subjects both in classroom settings as well as in the field. All of these have been proven false, that we do not have consistent opinions and beliefs. If you do standard tests, you can see that it does not follow the way theory says it should. We do not use all available information. In fact, people have shown that decision making in stock purchases follows a very narrow band of information. We technically look at what we know and stay within that frame. We don't want to expand anything, so we don't use all available information. And we are certainly not unbiased by emotion and herd effects. We do follow herding. We are extremely emotional in these kind of decision making. So all of these have been proven false, so that lends further credence to behavioral models. All right. So more along the lines of behavioral finance, you have this investor psychology of overconfidence. Overconfidence means that, simply defined, is taking too much credit for success and not enough for failure. So it's like we have a compartmentalized mind, that we give ourselves too much credit for successes and pass the blame off to somebody else, and don't take that blame on and always explain that away. And then that, if we do that often enough, that leads to certain behavioral patterns that are consistent with overconfidence. Okay, and so there are some of these statistics that are there to show how overconfident we are as a society. 70% of negotiators believe they'll win. 80% of drivers believe they're among the best 30%. So, I mean, obviously these are not possible, but that's, if you poll drivers, they'll tell you they're all best, and they all can be best. So more importantly for us, what are the tangible results of overconfidence in the investment arena? And one of them is a higher trading volume. When we believe that we have this incredible power to pick winners all the time, well, we're going to be trading a lot. In fact, we see that so if you look at market cycles, we go through up cycles and down cycles, and there are ways to classify up markets and down markets. During markets when things are going well, when things are, markets are more going up, and you can invest in almost anything and make money. And in those periods, people have developed these incredible amounts of overconfidence because people tend to pat themselves on the back and take credit for, oh, I'm such a great stock picker, right? Where most of the gains they're making is because markets went up, not because of what you may have done, but because, you could have thrown a dart at a stock and picked it and it probably would have made money for you. And we've been through periods like that in our history. Not too long ago, in the last 20 years, we've gone through those kind of bubbles, period of bubbles where anything you invested in more or less made money for you. So those are precisely the times when investors develop this fantastic sense of self, that they feel, oh, it's all me. I know how to do this thing. It's an easy game to play. And then reality strikes, because then those kind of conditions are temporary. They go away, and then suddenly you are back to reality where you're losing a ton of money because, well, guess what? Markets are not cooperating with you. And so this is a very consistent, well-studied, well-reported phenomenon. Not that it stops us from feeling overconfident as a society. Just like knowing all we know about Ponzi schemes does not stop us from falling victim to it, even as we speak. Things are happening. So those are kind of things. So for us, as investors, rampant overconfidence leads to higher trading volume and higher volatility, or higher uncertainty, greater uncertainty in markets, or greater risk, because volatility is associated with risk. So those are the two things that are. So higher volume is not bad, because that gives us more liquidity, but higher volatility means that there's more uncertainty, and you're more likely to lose money in these kind of high volatility situations when you trade. So talking about stock picking, there is this whole notion of Beardstown ladies, which is a little bit of a dated example now, but this is a good example of, I continue to use this because it really reflects how hype and marketing can make somebodies out of really nobodies, and how they can capture. So does anybody in the class know about the Beardstown ladies? Have you heard of the Beardstown ladies? Okay, nobody, zero. Okay, one, all right. Yes, sir. Good for you. Oh, you read my book. Okay, sorry. All right, that doesn't count. Okay, so you had to have an external source of knowing. Okay, so there were these ladies. So stock market, very briefly, this is going to be a short story. The book covers this in more details. But so there are these. So stocks have always had this aura of you need a lot of training to understand. And I personally believe that to be true, that you can't just sit down and decide you're going to be this great stock picker one day out of the blue. Well, so these ladies, there were this bunch of ladies in Beardstown, Illinois, that suddenly became famous in the 80s because they defied traditional, common sense and all this thing we knew about stocks and understanding stocks. There were these ladies who were, would meet once a month. There's like a stock investment club, basically, comprised of these seniors who would bake cookies and make cake in the oven and meet in somebody's dining room and pick stocks. And apparently they were picking these winners consistently. And then suddenly they became the media darling. I mean, they were on all these national shows, and they were being trumpeted as, oh, look how these ladies with no real formal training can make so much money. That flies in the face of all these MBAs and all these, so-called professionals who are, claiming, that you need all this training. Look, these ladies don't have any training, and so they became these celebrities. For a while, they had their own show, they had their own book. They were apparently beating the S&P 500 by, few percentage points, and they had like 21%. I think they had a book which had 21% written all over it in the cover. And for a while, this was great. I mean, they had their own fan base. I mean, the ladies had their own fans following them around. They did tours. They were, doing gigs out and traveling, and it was a hoopla. I mean, it was unbelievably crazy stuff, until somebody looking at the math very closely figured out that the ladies were reporting all these numbers wrong. And once you did the math correctly, they were in fact not only were they not beating the market, they were really losing money in a big way. They were underperforming the S&P 500 by not even, by a long shot, by significant percentages. So here's a little bit of the sort of the bulleted points of the, and 23.4% was, so the 23.4% actually turned out to be 9% once you did all the math correctly about investment returns, and it was just about half the average market return. Now you would think, if markets were rational, and this is again a knock on rational theory. Now if we were all rational and this happened, what would we do? What would we do with the ladies after that? Now remember, this is not the Middle Ages, so we would be gentle. But no, what would we do? We would at least ignore them, right? Say, okay, these guys didn't really know anything. We were silly. We looked silly. We shouldn't probably pay much attention to them after that. Well, no, that's not what happened. People who believed in them continued to argue their case. And so they continued to be famous because their fans, their loyal fans, continued to stand by them and say, no, these ladies do know something, even though the numbers were saying otherwise. America's great. I mean, I love the country, but and so they continued to be famous. And even after it was revealed that they really didn't know anything other than the fact that they were a nice story, it was a nice narrative that may have caught the fancy of people, but really in terms of stock picking, they weren't really doing much of picking. Anyway, so I'll let you draw your own conclusions as to whether the ladies got a rough deal or not. But so that's sort of I'll leave it at that. So Warren Buffett, and Warren Buffett's idea is very different. I was reading an article the other night on where he said that, and this is something which was kind of nice because that's exactly what we try to talk about in this personal finance class. But coming from an authority figure like Warren Buffett makes a lot of sense. That there is no magic rule of making money. If you plan and conservatively invest and just do the things right, you can make money over a lifetime. That's his message. Don't try to hit it out of the park. Don't try to get greedy. Just do the right things, invest for the long term, be strategic, and just look for modest gains. If you can do that, and if you can control your spending, that you're disciplined in your spending, and you invest sensibly for the long haul, you can build a pretty decent nest egg for yourself and your successors. And that's it, basically. There's no magic formula to becoming rich. It's not a question of, I think what we tend to get lost in this process by trying to do too much too quickly. We are, as a nation, we're not patient in that sense. We see all these glamorous lifestyles of people, and we sometimes forget how they got there, or we're not interested in knowing how they got there. We see the final product and we want to be like them, and then we try to get there really, really quickly without going through all the intervening steps that those guys may have gone through to get to where they are, and that's where the problem starts, right? So moving on, in terms of holding on and investing in the long haul that Warren Buffett says, when you do all that, it's been shown that individuals have this habit of falling into what is called a disposition effect. And the disposition effect is we hold on to losing stocks too long and we sell the winning stocks too quickly. This is a fairly well-studied effect on an individual stock level. And again, the idea is there's a lot of behavioral, interpretation of that. Why do we do it? Well, we don't want to admit maybe a defeat or a loss to ourselves. Therefore, we think it'll rebound. If we hold on to it a few more days, it will rebound. It will come back up in price. And so we continue to try to give it a second, third chance, fourth chance, and so on. And leading to hanging on to these things way too longer than we should. And we sell the winning stocks prematurely because we are afraid that if we hold on too long, we might lose out on them, and the gains might be wiped out. So there is all this behavioral stuff that goes into biases that go into making this the disposition effect a reality. So, okay, so now, in the heels of this, we're going to talk about the efficient market hypothesis, which, as I told you, is the brainchild of this most recent Nobel laureate in economics, professor in Chicago, University of Chicago, finance department, called Eugene Fama. he in the 70s, about 40 years ago, started and defined these efficient markets. Now I'm going to just talk about it very briefly in the sense that when markets are efficient, what does it mean to say markets are efficient? Markets efficient broadly means that the stock price that you see reflects all of the publicly available information in that stock at any given time. So when you have these publicly traded companies trading in the markets every day and you see the prices, those prices in an efficient market represent all of the publicly available information in that stock available at that point. That's very simply what an efficient market is. So when we say a market is efficient, that's what we mean. So if we were to say, okay, what is the market value of IBM? How much is IBM worth as a company? If I were to pose that hypothetical question, in an efficient market, that answer is very easy. And the answer is simply, go look at IBM's stock price currently, multiply it by the number of shares outstanding, which is a fixed number, relatively constant number, and that's it. That's your measure of the worth of IBM as a company at that point in time. And you can only do that. You can only do that when you believe that markets are efficient. Therefore, when you have underdeveloped economies, emerging markets, for example, which have other issues, a lot of stock markets are not as developed, those are not efficient markets. And there, you cannot invoke the same rule to evaluate companies, to properly value companies, because you cannot make the efficient market argument in stock markets that are located in less developed economies. But in developed economies, such as ones in the US, in Great Britain, in Europe, Western Europe, you can make the efficient market argument, and you can then use that as a way to value companies and all that very easily. So that was basically his idea. And he had this guy, Fama, as I've told you before, totally looks down and thinks that this behavioral stuff is all hogwash, that it means nothing, it's just a passing fad, it'll go away, all of this means nothing, it's just whatever we are reporting as behavioral biases are nothing but aberrations. They do not tell the whole story. So that's his, and one is not surprised why he feels that way, because this is his life's work, is market efficiency. And if you go against that, then he really has, and it's tough for people to Anyway, so that's sort of where we are with efficient markets. I'm going to move on here. Okay, we're going to talk about stock market indexes or indices. So stock market indices are a way to. So the history of the indices is the following. About 150, well, about 120 years ago, a reporter called Charles Dow, a finance reporter, a beat reporter on Wall Street in New York, made a curious observation. So he used to report these, the stock market and activities. In those days, it was a small affair, more clubby. It's still clubby, but it was very small. And so it was, it was camaraderie, and he would go in the evening and watch these traders drink and, talk about stories and what happened on the floor of the exchange and all that. And he would report on that the next day for the paper that he worked for. Then in the course of all this, hanging out with these traders in the evening, he suddenly saw that there'd be days when these guys would be very cheery and they'd be toasting each other, drinking into the night. And the next day, the markets would do really well. And then there'd be days when these guys would be crying in their beers and they'd be just, all over themselves because they just couldn't believe what happened. And the next day, the markets would tank. So he made this over time. He sort of saw the pattern in this kind of behavior and what would happen in the markets like following. So he said, okay, well, there might be something to this sentiment stuff. How can I capture this mood, the market mood? And so what he did was he started following the stocks, important stocks of the day. We're talking 1880s, 1890s, okay? So that's the period. And so he took the 12 stocks that he considered were important companies in those days. Most of them were railroad stocks and steel mining companies and all that. And he simply started adding their closing prices, all 12 stocks, dividing by 12, and coming up with a number, an average number, that he started publishing. And over time, that started, there was a trend. Obviously, sometimes the number would be up, down, and all that, and so he'd graph it. And he started reporting on that number. And that became the start of the New York Stock Exchange, the index, the Dow Jones Industrial Average index. It was, in 1930, it was extended to 30 stocks from 12. But it's remained that way since then. It is not changed. It still reports, and so it's the original index, if you will, the first index that we've had, and it continues to be reported today. Although it's not much good for academic studies. Academics don't use that. Academics use the second one, the S&P 500, more for gauging market movements. But indexes are or indices. I keep saying indexes, but indices are a way to capture the pulse of the market overall, right? So that's, if there's one, how can you use one number to tell the story of the market overall? Turns out that an index might be your answer, right? It's like a pulse, overall pulse of the market. And it turns out that there are many, many indices, looking at different aspects of the market. So you have the original Dow Jones Industrial Average with 30 stocks, 30 of supposedly representative stocks that are reported. And then you have the S&P 500, which is a Standard & Poor's 500 stocks, average of 500 stocks. And then you have the Russell 3000, based on 3,000 large cap stocks. So you have all these things that, and there are many others. We have a link, I think, right? Do we?
I don't think so.
Okay, you're going to put the link. So many other indices that cover different aspects of the market. But the idea is that indices are nothing but a way to look at the market overall. Okay, look at the market overall. Now, the original Dow Jones Industrial Average is what is called a price-weighted average. What is a price-weighted average? Price-weighted average is simply where all stocks are given equal weight. So you simply take the closing prices of 30 stocks and divide it by a number, a divisor, and that gives you the value of the index. So you do not adjust for the fact that some stocks might be large, some stocks might be relatively smaller, because it is a fact of life that when a large company goes down or up in value, that impacts markets more than if a relatively smaller company has a similar percentage movement. Dow Jones Industrial Average is a very simple index. It does not account for that. So the next one in our list is the Standard & Poor's, which is the blending of 500 stocks, but it's also value weighted. Okay, so that's important because the 500 stocks are not all equal in size. There are some relatively larger companies, some relatively smaller companies in the 500. And the index actually weighs them differently. So if a relatively large company has a 10% move in its price on a given day, that's going to impact the index overall much larger, in a much greater way than if a relatively smaller stock in the index has a 10% change, because it's weighted differently. It's weighted by size of the company. So that is actually an improvement, because it accurately reflects how people behave when stocks go up or down. And so and S&P 500 index is widely used as a measure of market, as a measure of the overall market performance. So if you want to know what the market is doing, you want to check and see what the S&P 500 did that day, and that sort of is a quick way to see what the market did. If the S&P 500 went up, that means the markets overall went up. If the S&P went down, that means the overall market went down. And again, this has its critics, just like the Dow Jones Industrial Average has its critics. It's too small, too few companies, it's not value weighted and all that. S&P 500 also has its critics, and they say that the top 45 companies out of the 500 comprise of over 50% of the S&P 500's value. So it's top heavy, basically, is what people say. And also that very little foreign content. It's basically primarily domestic stocks that are reflected in the 500. Other indices that exist, are the NASDAQ market index that tells you how the NASDAQ market, and then a lot of these other indexes that you can, are indices, as you can look and check. Okay. I think we blew by everything. Cool. Any questions? Let me see what questions there, so we have some time.
I think or do you want to just scroll through this one?
Let's just go through here. Okay. So I don't really get the stock index, so the indices. So the top 12 stock prices are added together each day, and the number is related to how the entire market will do the next day. Yes, basically correct. So what you do is you add up the 12 prices, divide it by a number to get the average, and then that, over time, is a trend, gives you a trend, an upward trend or a downward trend, which then reflects how markets do. That's the idea. So it's not like one day you're going to get a number that'll tell you what will happen next day. No, no, no. That's how the numbers are calculated, but it gains effectiveness as you have more time series data. Over time, you do it for 2 months. Then you have a nice graph that shows how the markets have been doing. Is it an upward trend? Is it a downward trend? And so on and so forth. So that's the value. Is the Dow Jones Industrial Average still useful today? The answer is it is useful in the sense that evening news, if you follow evening news, they will always close by saying the Dow went up by 2%. The Dow is nothing but the Dow Jones Industrial Average. So even though it is lost a lot of its glory, it's still a staple of evening news. So, you know. I'm not going to talk much about the Bollinger Bands because it's not that I can discuss with you privately. I'm going to leave that one alone. I don't really... Okay, so when you talk about publicly available... Okay, yeah, that's a good question to ask. What is publicly available information? Publicly available information is stuff that you read about. Everything that's out there in print is publicly available. So a lot of times people will say, oh, if you read my newsletter, you're going to make money. You may have seen these commercials where people boast about, oh, if you subscribe to my newsletter, you're going to get these tips that nobody else has. Guess what? They're just taking you for a ride. Because if they're selling it to you, they're selling it to 200 or 2,000 other people. Everybody's having news, and they're giving it to that. It just doesn't happen. Though that's all publicly available news that's being repackaged and trying to take your money for it. Those will not make you, beat the market by a long shot. So all that is public domain. When you have news that nobody else has, that's private information. And you can make money out of that one time when you trade on the basis of that. But all this other stuff is all out there in the public domain. That's what's public information. Anything that's... Should we as individual investors care about these indices? Absolutely. You can take positions on indices. I don't know if you knew this, but there are investors that take position on whether the index is going to go up or down in the near term. You can take bets on the market and make money or lose money in the process. So yes, there is, and also you want to know what the markets are going to do. If you want to know the broad trend of the market, then you study the indices. So yes, there is a lot of value to stock index. Let's see, can you go down further? Or? Is stock valuation based on company fundamentals? Why are individual stock prices influenced by the market as a whole? Well, in stocks, because we are in this beauty contest kind of thing where things can be bid up or bid down. I mean, you have this happening in the NFL all the time, right? You have $100 million contract signed by a linebacker who is a total bust, right? Because there was so much hype accompanying that person's worth that some team overpaid. And then it turns out that was a total loss because that person, Washington Redskins, if you remember, there was a big signing, $100 million contract for a linebacker that didn't do anything and was cut. But, he's still making millions of dollars in payoffs. So it happens all the time. So yes, even though stock prices are determined by fundamentals, sentiment, popularity, fads, all these things also contribute to its value in the short term. So all those things get mixed up. For our investment project, what specific stocks would you invest in? Examples? No, I'm not going to tell you that. It's for you to figure out. I believe, is volatility a good or bad thing? Overall, I would say it's a bad thing. Now, there are traders, professional traders, who trade on volatility. For them, it's a great thing. They love volatility because they take positions in that and make money. But for us investors, individual investors, volatility means higher risk. So it's a bad thing. Our contracts with brokers flexible. I don't know what you mean by that, but these orders are not flexible. Market orders, limit orders are well defined. How many times do professional stock traders trade? 300, 400, 500 times, or even a lot more sometimes. A lot of times.